Hey everybody, Matt here. So today we're going to compare the three biggest financial crises in America's history: the Great Depression, the Great Recession, and the Great Pandemic. Don't know if it has an official name yet, the one we're in right now, but we're just going to call it the Great Pandemic for the purpose of this video. And we're going to try to see if we can spot some similarities and differences to try to see where we're going in the pandemic we're in right now and how it's going to affect the economy and markets based on the two other largest financial crises that we had in this country. So yeah, let's get into it. So starting off with the Great Depression, and before we talk about the Great Depression, we have to talk about the Roaring Twenties. And no, not the 2020s, because we definitely are not in the Roaring Twenties right now. So back in the Roaring Twenties, which began in around early 1920s, it was America's most prosperous time up until that point in history. More people had jobs than ever before, and there were new products being created every single year that made people's lives better, such as vacuum cleaners, refrigerators, washing machines, just these simple household items that today we take for granted. Imagine living without a washing machine today, and imagine how people would have felt back then if they had one. So everyone had to buy these new items that kept coming out. And so because of this, this really popular thing also came out in the Roaring Twenties known as credit. Yes, that was pretty much the time when credit was sort of invented for the mass public. And so because it was so new, people didn't really see the consequences of spending all this credit and putting everything that they purchased on credit. And so eventually everyone defaulted. Not everyone, but a lot of Americans defaulted on their credit card. Hey, it's Matt here. So I'm editing this video, and no, they did not have credit cards back then. I don't know why I said credit cards, but they did not have credit cards back then, which actually sent the Dow Jones tumbling 25% in just 5 days during October 1929. The GDP in the U.S. fell by an estimated 15% during the Great Depression, while the unemployment rose to 22%, the highest in the history of the nation. So it was a pretty incredible time. I would say the Great Depression, though, had a larger impact on the economy than the overall markets. 15% to the GDP is massive. So the Great Depression hit the economy and the markets very, very hard. And it was mainly because of consumer spending. And it really was the fault of the lenders as well, because they didn't really go in depth to see people's incomes and to see if the individual actually could pay the money back then, because it was such a new thing. That, it was just a disaster waiting to happen. So that was just a quick look at the Great Depression. Let's move ahead about 80 years to the Great Recession. It occurred in 2007 to 2009 was kind of the time period for the Great Recession. It was mainly caused by poor lending practices from banks to individuals looking to buy houses, especially. Essentially, they would lend too much to individuals who wouldn't be able to pay these amounts back, and because of this, it eventually snowballed into just this massive collapse on the economy. Another factor that contributed to the economic collapse of the Great Recession were credit default swaps. They're basically financial derivatives that guarantee against bond risk. They sort of work like insurance policies, except these insurance policies went unregulated by the government. So a lot of this bad debt was being packaged together with good debt and giving people a false sense of security, which eventually led to the collapse. The Dow Jones declined nearly 50% from October 2007 to March 2009. So comparing that to the Great Depression, the market actually tumbled twice as much compared to the Great Depression, which is actually massive. The GDP in the U.S., however, only declined 2.5% compared to the 15% decline during the Great Depression. So this really didn't have a large effect on the economy. It really just had a huge effect on the markets. And unemployment rose during this time to around 10%, so still lower than the Great Depression. So you could say that the Great Depression had a larger effect on the economy than the Great Recession, but however, the Great Recession had a larger impact on the markets. Some similarities we already can see between the two of these is that they were both caused by pretty much irresponsible lending and consumer spending, which ended up ruining hundreds of banks in both instances. Great Recession, the Lehman Brothers, if you don't know, one of the largest banks, as soon as they fell, it was really just kind of like a big snowball effect afterwards, and hundreds of other banks collapsed over the next several years after that. It was a pretty bad time. And both took quite a while to recover, actually. With the Great Recession, it took about 4 years for stocks to reach the previous levels that they were before the recession started. And with the Great Depression, it actually took 25 years. So the Great Depression definitely had a larger impact, and that's probably because it impacted the underlying economy and not just the market. With the Great Recession, the market wasn't really hit that hard, but with the Great Depression, it was hit very hard, and so that's why it took, nearly 5 times more years to get back, almost 6 times as long to recover to its previous levels. So now that we have some context for these two depression and recessions that have happened in America's history, let's talk about the coronavirus pandemic. It mainly caused the crash of the markets because of the government's quarantine response, which was necessary, of course, because it did save lives. But it absolutely crushed small businesses in certain sectors, such as entertainment and travel, that were really hit hard by this quarantine. Since the financial crisis we're in right now is still ongoing, we actually don't have the final numbers, but as of right now, the unemployment rate is 15% and climbing, and they're expecting it to get around 19 to 20%, while the Dow Jones is down around 17% from highs this year. This is actually up quite a bit from what it was. It was down around 40% near March, and it has been climbing up to around down 17% from highs this year. So it's actually climbed up quite a bit. It hasn't fully recovered, but it has climbed up quite a bit, recovering about half of its losses. And we don't know the effect on the GDP that the Great Pandemic has caused, but they're estimating it to be around a drop of 30%, and I'll link some sources down below for that, but that's massive. That's even larger than the Great Depression. And considering that we have an unemployment rate that's 15% and climbing, this can be more closely related to the Great Depression than the Great Recession, as it's impacting our underlying economy much, much more. So what does this mean? Well, since the numbers are most closely related to the Great Depression rather than the Great Recession, it's reasonable to assume that it'll last another few years before we're back to where we were in the stock market. Maybe even longer than a few years, because the Great Depression, as we saw, it took 25 years to get back to the original stock prices. So it could take us quite a bit of time. And yes, the stock market does not equal the economy, but eventually they sort of catch up to each other, and right now they are not anywhere near each other. And I don't think that the market is going to actually go up to all-time highs by the end of this year or by the end of next year. So I would definitely be cautious when investing right now. However, I will say the banks weren't the ones that were hit really hard by this, like the Depression and the Recession. It was mainly the airlines, the cruises, and the small businesses, which make up only a small percent of the overall market cap of the stock market. And because the stock market adds more weight to larger companies with high market capitalizations, it mainly moves with those companies, because the largest companies such as Apple, Amazon, Microsoft, and Netflix have been doing well throughout this crisis. Their stocks are intact and helping keep the market up. Not only this, but we have unlimited quantitative easing, which is something we've never seen before, allowing banks to essentially borrow as much money as they need to lend to individuals and businesses. So with these things factored in, I don't think it'll last as long as the Great Depression, 25 years. That's a very long time. So because of all the things that the feds are doing, and because we have different types of industries hit by this pandemic than the Great Recession or the Great Depression, it's not really hitting our banks, which is really good because the banks are really essentially the backbone of our economy. Because it's hitting these other not super significant, I'm not going to say they're not significant because they are significant, but because they're hitting these sort of less important sectors of our economy, and our big, strong, heavy hitters like Apple, Amazon, Microsoft, Facebook, Netflix, the FANG stocks, are all doing actually pretty well. I think that we are going to see a recovery sooner than the Great Depression, but it's still going to be about 2 to 5 years, I think, before we reach all-time highs. If we're lucky, when we get a vaccine for the coronavirus, we may see it jump back up to all-time highs, but I don't know. They're saying it's going to be a year and a half till that happens. It will be some time, definitely, before we hit all-time highs. And you've seen lately that our market's been trending up and up and up. And so this kind of concerns me because it can't go back up to all-time highs this quick. Something that affected our economy this badly, it can't just last a few months. It has a longer impact than that. So when it gets really close to all-time highs like right now, you kind of worry. You kind of worry about investing because you think it's going to keep going up, but really, historically, we haven't seen it, recover so quickly. So it's really a good time to be cautious right now. I definitely would invest a little bit, but not your whole portfolio. Definitely keep some cash on the side. Look at Warren Buffett. He's the genius of investing. He's made massive returns throughout his career, and he is holding mostly cash right now. So follow his lead, and I'm sure you'll do fine. Anyways, I just wanted to make this video comparing the 3 different economic collapses in America's history. Hopefully you found some useful information throughout this video to help you make some better investment decisions during this time. It's truly a time that we have never seen before. You know, the other ones, it was basically caused by our banks, essentially. So we really don't know for sure how the markets are going to recover or when they will, but it will be sometime. I don't think it's going to be anytime soon, especially because how hard hit our employment rate is. We're already down to 15% unemployment. They're expecting it to go to 20, which is incredible. So it will be some time before we recover from this. Anyways, hope you enjoyed this video. Like and subscribe if you did, and you can check out 2 of my previous videos right here. Thanks.